We welcome now Afsaneh Benschloss, CEO of RockCreek, and Greg Peters, Co-CIO of PGIM. So, Greg, let's start with you. What are the markets trying to tell us?
Markets are trying to tell you, David, that the Fed has a lot of work to do. Inflation continues to be quite persistent. What I think the inflation numbers showed us is that how broad-based it was. So the focus was on the core number, and the core number came in double what was expected, and the markets were leaning the other way. So I think this is just a reaffirmation that inflation is entrenched in the system. The Fed has a lot of work ahead of itself, as do other central banks, and the markets need to adjust. Yields need to adjust, and the economy, as a consequence of this higher rate environment, needs to slow down.
So, Afsaneh, it looked like the market started to adjust certainly this week. At the same time, how much work does the Fed have in front of it? Because we keep hearing about there's a lag in monetary policy. At the same time, it looks like they're behind.
You're absolutely right. And what is happening is now I think the market has accepted that we're going to be closer to 4.5, maybe more in terms of terminal rates. And that was what shook the markets this week. And as Greg said, this is not just in the US. I think the ECB is behind the curve. The Bank of England is behind the curve. So this is more than just the US phenomena. But no question that the medicine will be tough over the next 6 months. And our expectation here is that we would probably end up at probably 4.25 by the end of the year.
Well, the medicine's tough, Afsaneh, but is there any danger the doctor might prescribe too much of the medicine, overreact, because it takes a while for it to kick in?
You're so right also, because policies take a while to work through the system. So we know in Economics 101 that policies, especially interest rate increases, can choke off the housing market. For example, they've started, with 6% mortgage rates. You're going to see the housing market hugely impacted, but that takes not next month, but a couple of months to work through. So no question that we could overcorrect. But I think the Fed, now feeling that they have fallen behind, has that danger of overcorrecting. I think the good news there is that they can always bring in interest rates down a little bit in the early part of next year, but most likely they will be very careful before they do that, because we have seen with Volcker and others, if you bring down interest rates down too soon, you will also have problems.
Greg, there seems to be a pretty broad consensus that the Fed was late to get started, both on rolling off the balance sheet as well as increasing interest rates. At this point, how do they maintain or regain their credibility? Because for a long time, we basically believed in the Fed and it would take care of whatever the problem was.
Yeah, and I think that's the central part of the story, in that they have to get inflation down. I think they realized that they were slow to react, that inflation wasn't transitory. It's become much more entrenched. It's global in nature, as we just talked about. So the way that their success is measured is one way and one way only, and that is bringing inflation down. And the unfortunate collateral damage in bringing inflation down is the economy. So while housing is slower to react, I think what the Fed and other central banks are really focused on is bringing inflation down, because credibility is based on that fact alone. If you think about the prosperity that we've had, at least from a market standpoint, since inflation has been under control, since central banks have built that credibility, they need to get that back, and that's what they're desperately fighting for.
Afsaneh, as you know terribly well, the Fed has two mandates. It's full employment as well as stable prices. Right now, it looks like they're focused on the second, that word unemployment. How does this work for wage earners as a practical matter? Because on the one hand, you want wages to go up. And by the way, real wages, if anything, have been going down, not up because of the inflation. At the same time, if you really have inflation rampant, then what they're making is not worth very much.
So the emphasis was on increasing employment, and that worked in the first part of the correction. And I think that was what actually led to the Fed being so late in moving towards more equitable and more equitable economy. And that is what led to this inflation, which is unacceptable, obviously, to everyone, including wage earners, who are now in real terms getting less. But there is what we're seeing now, for example, with the port settlement this week, with a number of unions getting formed, existing unions successfully renegotiating wages, that we might end up in an economy, and I don't want to be over positive about this, but I think there is a really good scenario where the dance stops sometime next year. Wages in real terms might end up in a better place. And by that, I mean higher. That is obviously going to be at the cost of earnings going down, which means that there will be a reallocation between different stakeholders. And a lot of stakeholders have been talking about labor getting a bigger share of the economy, and that can either be leading to an inflation spiral or something has to give. And if you could get into an economy where wage earners are buying more, that leads to more consumer goods, it leads to a better growth rate when we come out of this. So I wouldn't be so negative when I read the news about student loans being forgiven or wages going up at this point.
So, Greg, for a long time, it looked like we were solving the equation for the value of assets. We were getting asset values up, which we were pretty successful in doing overall. If, in fact, we're going to take the move that Afsaneh is suggesting right now and say, let's focus on wages a bit more than assets, what does that mean for asset holders? Do we have to have a regime where we're shifting away from asset values toward wages?
Yeah, so I think Afsaneh is spot on with this notion. And the Fed basically telegraphed this when they talked about part of their mandate is inequality, and inequality is wages. I think what we've seen with this widening of the wealth gap and inequality, just growing wider each and every year, is that this trickle down aspect where the Fed's at zero, asset prices go higher, and the rest kind of benefit from that. You really haven't seen that. So the fact that actually wages are going up is a real positive. I do think that has an impact, though. Margins will come down. They're at all-time highs. So there is room for that. But I think we're moving into this new regime from less shareholder value into wages and worker value. And I think that is a story that's going to continue to be told here for some time to come.
Well, sometime to come. I'm just curious, if you agree with what Greg just said, are we talking about over a year, over 5 years? How long do you think this transition might be?
I think it's really in front of us as we speak. So I think these readjustments, we talked a lot about the negative part of COVID. I think this is the positive, could be the positive outcome. And what I think is you want more balance, right? You want more balance between stakeholders for an economy to prosper. If you have too much of the share of the economy going to one group or another group, it's never balanced and it's never good for growth. So I think this could be sooner than later, which makes me a little bit more positive that, what President Biden said may not be completely untrue. We might get into a better place sooner than people expect.